Welcome back, everyone, to another episode of Ready, Aim, Retire, the show that focuses on retirement planning. Where should your money be now? Your legacy, all through using expert wealth management. I'm Rob Kirvan, here always with Tony Shore. Tony, how we doing today?
Oh, we're doing good, Rob. Great
Yeah.
to be here with you. It's so great that spring is finally here. I've actually been getting work done outside, out
Oh,
of doors for the first time in a while, and
you guys have
actual
a
manual
different
labor.
weather than us because it's like 35 degrees here right now.
Actually, it's been weird. We'll have one day where it's 70, like
Yeah.
yesterday, and sunny, and today it's going to be maybe hit 45 or
Yeah.
40 and
That's where we're
lows in the 30s. But
at.
still, when it's not raining, you can still get out there in the 40s. If the sun comes out, it's not
And you
so
can
bad.
feel it. You can feel it's here. So there's no doubt about it. Tonight I'm buying a new lawnmower.
You
So
are.
yeah, ours
Excellent.
finally quit. So
You're gonna get one of those riding zero-turn mowers, the
I don't
fancy.
have enough lawn to do that. That would be
Yeah,
really cool though, but, like, I
yeah.
just have a regular lawn, so
Yeah, me too. I have a push mower, but my
yeah,
dad has a big zero-turn. I
yeah.
just like to go out there and drive it.
I do that at Natalie's dad's got a farm and he's got a zero turn, so I
Yeah.
I have gone out for a little rip, but I don't wanna get too committed or else I have to cut the whole lawn. It's massive.
Yeah.
So I just like,
Right.
yeah, I'll test it in the driveway, but I
Yeah,
don't dare
right.
get on the lawn because then I
Yeah,
get
when
turned
my
on
kids
by
were young, my dad would let them drive it. Like, it's like he has a go-kart and a four-wheeler, but they wanna drive the
oh, the
zero-turn
zero turn.
mower around the
Yeah, they're
driveway.
awesome. They're awesome.
They are, it's pretty cool, but,
Mm.
the only negative, Rob, I have to say, before we jump into the topic is that, it is allergy season,
Oh,
and I remind my wife of this because she hits me with this huge list of outdoor projects and landscaping and plants, and I remind her it's allergy season, and she goes, "What do you mean?" And I go, "You know, my main allergy is, to manual labor.
oh,
I'm completely allergic,
yeah, that's a
to
tough one.
any type of,
That's all year really then, isn't it? Like,
yeah, it is.
it
It's a
just
year-round,
it just stays with you.
but especially the outdoor, the planting and the digging and the landscaping.
Oh, yeah, that's no fun.
Yeah,
I'm lucky I don't have real allergies, but Katie here, like, so her office is down the hall from mine, I just hear
sure.
I hear the first sneeze. I don't say bless you yet because I know there's, like, 2 more coming. It's just like boom, boom. I'm like,
Oh,
"Bless you, Katie." Probably like half a dozen times a day. I go, "When does that end?" She goes, "I'm not sure." It seems like it's always once the season starts, it's kinda always there.
yeah.
Yeah.
I feel for people that have serious allergies. I get some
Yeah.
allergies this time of year, and real allergies, not my
Right,
fake
right, right.
allergy to hard work, but yeah, yeah.
Mhm.
So what are we talking about today? You said the show
Well,
is called Inflation Nation. What's going
Inflation
on right
Nation,
now?
that's what I wanna talk about. So the new numbers came out, Tony, and, how would I describe them? Ugly? So here's what we had reported this morning. We had inflation came in at 3.7%,
Ooh.
at an annual rate versus the forecast was 3.4. The other kicker on this report was GDP grew at 1.6% in the first quarter. The forecasts were 2.3.
Mm.
And another caveat, personal consumption. So over the last while, what's kind of kept us in the game is we're a consumer driven economy, right? So the unemployment rate is very low. So consumers keep buying and keep buying. That rate clipped down. So it was at 2.5% versus a forecast of 2.8%. So what does that mean? Well, it means that there's going to be headwinds in the market for sure. But the other caveat to it is mortgage rates now are firmly over 7% on a 30-year. You look at people that want to go get a new car, lease a new car, those rates are going to remain elevated. Like first time home buyers with that 7%, that's tough. That's tough to get your foot in the door. I have several clients that have been waiting to move. The inflation started about 2 years ago, as far as them starting to raise interest rates. Started in March of 22, and we saw what happened as they raised them in 22. Obviously, that's a huge headwind for the market. And we had several clients that were planning on moving, but they still have even if it's a small mortgage on their house, it's like there's principle to it. I'm paying 3, I'm not gonna pay 7, even though, it's under 100,000, it's probably negligible in as far as their retirement plan, like they don't wanna do it. So they're kinda stuck there, and that's what we've seen in the real estate market. The inventory is very, very tight because of people like that not wanting to make that move. And for the first time buyers, with the rate being so elevated, very difficult to get in, like we would have done in our 20s or 30s or whatnot. It's very difficult for them to make that first step. And once you make that first step, you're kind of, I don't want to say on easy street, but that's kind of how you build, long-term wealth in a home,
Right.
and get a different home and things like that. Right. So, so those numbers definitely shock the system. The market is not reacting favorably, Tony, currently.
No, the Dow dropped 600 points, I read.
Yeah.
That's the headline right now on CNBC.
Yeah.
Dow
Yeah.
dropped 600 points.
Yeah. S&P was down a lot. Obviously,
Yeah.
the NASDAQ, which is tech heavy, which they were planning on these cuts. So if you went to the beginning of the year, if you went to January and you look at all the analysts, that were forecasting interest rate cuts, and the reason, that they forecast these is once they started interest rate cutting cycle, it's very good for obviously people in the economy, because that, just like I said, that mortgage rate drops from 7 to 6.75 to 6.5, and allows people to get their foot in the door. Loans, credit card debt, all of these things start dropping, which is very favorable to individuals, right?
Right. And it drives consumer purchases like new homes, cars, large, especially higher
The
priced
large ones,
items that need to be financed. Yeah.
totally, like all of those, and each quarter point makes a big difference. Makes a big difference of what kind of home you can buy, what kind of car you can
Right.
buy, whatever you might be doing. But um, where was I on that? So where were we just at?
Well, the
I
consumer.
just lost myself, Tony.
No. Well, I was gonna say, my wife and I, you mentioned, just to go back really quick, you mentioned the, people not wanting to move out of their house because of their low interest rates
Right.
that they have. Our mortgage right now, our rate is 2.9 we're locked in at. And
Solid.
so we've stayed a couple years longer in this house and we're gonna stay there until the rates go down, because I for one am not giving up a 2.9% mortgage to purchase a house that's at 7.5. I mean,
Right.
that's crazy. It's
And it
what.
doesn't make, even like it doesn't make sense, and even like clients of mine that are retired, they're not planning on even staying in Illinois. They're planning on moving, whether it be Arizona, Tennessee, Florida, Texas, wherever they plan on moving. And they've kind of put that on hold,
Yeah.
because of these interest rates. And at the beginning of the year, we had, like I said, the forecasts were, 6 interest rate cuts this year, and we saw in November last year when the Federal Reserve came out and said, "Hey, we're not going to raise them anymore," basically without saying it, and the market has taken off. And even with the hiccups we've had over the last few weeks, the market's been up 18% since November. So take it in stride, in a sense
Right.
that it had to pull back, it has to correct. Good, efficient markets correct at least once or twice in a year. And then the latest reason happens to be this. But like when I look at the forecast this morning, after you see the GDP number come in, or not the GDP, the inflation number come in so high, now the forecast even drops worse. Like June has dropped to, what did I write down here? June is down to like 39%, and the odds of a cut in September are 63%. So we've went from 6, Tony, to really a possible 1 or 2, because this inflation is just hanging and hanging and hanging.
And I don't know if you remember, I said, what did I say, Rob? I think I said this in a previous show. I predict that, my personal feeling, this is just my personal feeling, there are not going to be any rate cuts this year.
Right. And that would make sense too, right? So the argument for that is that if the inflation stays high and the unemployment rate stays low, well, if the unemployment rate is low, there's more people buying stuff. So the way the inflation gets higher is because you have too many consumers chasing too few goods, right? So they can keep the prices elevated. I read this morning that gas in a town in California was $7 a gallon this morning. Like $7 a gallon,
Yeah.
and we're coming into that season where they naturally go up. People drive more, people are going more places. So the price of fuel that generally goes up anyway. And add this to the mix, we're probably going to see those big spikes like we saw a few years ago, where, down here in Illinois, it was close to $5 a gallon, for gas, so, it wouldn't surprise me that over the next little bit, we got Memorial Day next month, the official kickoff to gas gouging season, and then we'll probably see that elevated. And the more that inflation number is sticky and sticks around, people start to go through their savings or their money that was in there, because everything's costing more. Like, if you were a family right now with 2 or 3 kids, what does that grocery bill look like? Like at home, it's myself and Natalie, so it's not really a factor really. But if you had, like, 2 or 3 kids and your monthly food costs went from, I don't know, like $800, $1,000 to $2,000, but maybe that's a vacation you don't get to take. Maybe that's a sport your kid doesn't go in, or a music class, or whatever that may be. And it just seems like this is really hanging around a lot longer than anybody predicted. And even you saying zero interest rate cuts, that would make sense, but you could still have a lower inflation number. You could still have a number
Right.
that's
Hopefully we
lower.
will. Yeah. Hopefully
Right.
we will
Yeah.
have a lower inflation number. I mean, it started to lower and then it's crept back up the last two
It really has.
reports.
And
And
sorry, go
yeah.
ahead.
Well, and I think what you were leading to earlier, the point you were trying to make there is that it's a snowball effect, and it affects things when you have higher interest rates. People stop buying those goods, and then that hurts companies' profits. And so their projections, they don't meet projections. We're starting to see, Meta. The headline is Meta's down, way down below projection.
Meta was like, um when they came out on their earnings call last night, so their numbers were really good.
Mhm.
And if they didn't speak, their stock would probably be up. But unfortunately, they spoke, and their plan is to spend a gazillion dollars on AI, and that's going to fuel the ship. And Meta over the years has been pretty, forward on this kind of stuff. They're always kind of
Yes.
cutting edge.
Yep.
So they probably have something there, but investors don't like to hear you're spending money. They want to see the stock value go up. So it got clipped pretty good today. But some of the, to your point, you're seeing, when you see the slowdown, you usually see them with consumer companies, shipping companies, for sure, because they're shipping goods that we're buying. And we're not seeing massive slowdowns in that area yet, but we kind of have to. So it's a double-edged sword. You want lower interest rates, you're going to have some hiccups in the economy. That's just kind of what has to happen. Like, if the inflation rate was at 1 right now and the unemployment rate was at 7, well, yeah, you know what? They're going to cut interest rates, and stocks will probably go up, because they got better rates and they can grow, companies can grow more. But as a whole, I don't know if we're in a better spot, in that
Right.
situation. So there's probably a balancing act. I know they're trying to do a balancing act. They're having a very difficult time doing it. And we'll kind of have to see what happens coming forward. But, like, when you look in June, and the rate cut projections down to 39%, unless you get some big print in the next couple months, that's probably not going to happen either. So these 7% mortgage rates might be with us much longer. And you know what? I have, friends in that industry, clients in that industry. It's tough. The mortgage business as a whole, depending on what firm you're with, 40 to 60% of their revenue is on refinancing mortgages.
Yep.
Well, you just told me that I ain't buying another house because I am not going to go to a higher rate. So somebody sitting there, with a 3% is not going to refinance to get a 7%. It just doesn't make any sense.
Or 7+%.
7 plus. Like, I think I
Yeah.
looked this morning, was 7.3. So
Yeah.
yeah, and the 10-year treasury, which drives all of this, when inflation is up, and there's uncertainty, and things like this are in the air, it goes up. And when the 10-year treasury gets close to 5%, which it currently is, stocks generally go down. So definitely in this pullback maneuver. We had earlier in the week, it kind of flushed out last week, and then it looked like, oh, we're back on track. Monday, Tuesday, yeah, rah rah rah. But that is the market, and that brings me to this point, Tony. That's why you have to be active. Like all our strategies are active. They're rebalance quarterly. As companies report and they're not so great, they move out of the portfolio. We move the ones in that have a better upside into the portfolio. So that part is very important as far as if you're listening out there and you're maybe a do-it-yourselfer, or you got a 401k, just making sure you're listening to the news and going, okay, where should my money be now? And you're seeing this move, the way a 10-year treasury goes up, Tony, is people buy a lot of it. That's how it goes this way, so you're seeing that move in there. We have the stable value fund that has done very well during all this.
Yeah.
And that's kind of where you'll probably see assets moving, over the next, 3 to 6 months, until they get better numbers coming in.
So, yeah, the inflation numbers are tough, and that's the thing I hear people complaining most about. That's what affects the most people
Right.
out there. Of course, stocks, that affects people and your clients. But the good news with stocks is we know eventually the markets go up and there are corrections and things like this. But I'm not worried about, I think it would be great if we can get the interest rates lowered. And I'm not worried about it because I know that you can pick up the phone, call your friend Jerome Powell, and
Right.
I know the influence you wield, and just say, Jerome, here's the deal. You got to cut rates a little bit for us.
Right. Right. You know what? I wasn't going to make the call, Tony, but I think I'm going to have to on behalf of my clients. Definitely help them out. But you're right. We're long-term investors, so there's always some sort of headwind, in any market cycle. This one happens to be the inflation headwind. Last time we had this was 40 years ago, your late 70s, early 80s. So, once we get to the other side of this, hopefully we're going to be in a good spot as far as inflation goes for a while, and that's going to help housing. Like the biggest housing benefactors right now are the companies that do the new starts, the new homes, because they're able to eat some of that interest rate because they have incentives and things like that for somebody walking through the door. So those guys are literally knocking the cover off the ball. Well, realtors and mortgage, like they're hanging on the vine right now. And coming out of this, you're going to see a lot of damage in that industry. You're going to see a lot of mortgage brokers getting different, going into different avenues. You're going to see a lot of realtors going into different avenues because, a lot of people can survive a year, but now you're on to 2 years, and it looks like it's going to be, my personal feeling is it's going to be pushed down a little bit, and we'll see when we get the spring numbers in for housing and things like that. But again, it's one of those things where you can't control what the inflation is. You can control, kind of where you invest your money, what you're looking at, have those conversations with whoever you work with, to make sure you're in the right spot. But taking that long-term approach and not doing anything quickly, I'm going to say 100% pays off. I can't use the word 100, but it always pays off, Tony. Like if we sat here 5
To
years
not
from
let
now,
your emotions dictate
and that's what
your
happens.
financial decisions is always a good move to
And you're
not let
seeing
them
when the
do that.
market goes down, like you said, 600 points, it goes down because people are selling. So people see the inflation number go up and a little panic sets in, and says, oh, geez, oh my gosh, the world's falling, they're like everything's collapsing, all that kind of stuff. And they sell, and if we look, a week or two down the road at every, all those things, well, they're probably up or they're probably coming back, but we really haven't had a 10% correction. Like we got to 4.5, 5 in that zone. And that's okay. That's like that's a tame one, and that happens too in any given year. But we haven't had, since this big 18% run up, usually, and that's after we've corrected about 5%. But usually you'll get a 10% or something to really make people nervous, something to really get people's emotions working for them, Tony,
Right.
making,
Right.
making, tough decisions. Like individual investors, every study will show you, and we show that study sometimes where, because of emotions, they average far less than the market, far less than a money manager, far less than, if they engaged, somebody to help them out with this stuff, because their emotions take over and they get into times like this. And if the market continues this downtrend tomorrow, Tony, on a Friday, look out. Look out. Like, yeah, and we haven't had that big washout day either in this whole correction. It's been kind of, kind of going down a little bit. So I think that, we'll be in this correction mode a little bit while people digest this information. But the inflation thing is real, and we have to do our best to kind of navigate through it, not panic, but navigate through it and understand that there's a lot of good things there's a lot of good tailwinds that will help us out. We were hoping they were going to help us out sooner, Tony. People thought there would be a cut in March, and we've been on the show and said that's never going. I didn't say it's never going to happen, but I'd say very unlikely. But I would have given June, at the beginning of the year. I would have said they might pop one in June and one in December, kind of thing. But it looks like June is it's not off the table, but geez, 39%. I don't think I would bet on those odds. Those are kind
No.
of low. So we might be all the way until, September before they see something, maybe something right before the election, who knows? But you might be onto something. You may not see any rate cut this year. And the other thing is if they cut 6 times, Tony, the reality of that means our economy is in trouble. Like, high interest rates means your economy is doing pretty good. Things are going along pretty good, even with that GDP print that was kind of low.
Like
Um,
in the 80s when it was like 12,
right.
14%, the
Yeah.
economy was plugging right along.
The economy was booming, it was booming. So people dealt with that, they dealt with and eventually Tony, I don't know if we ever get down to the 3%er that you're holding on your house. Like, I don't know if that's going to be a thing. And if it is, it's going to be way down the road. I feel, but again, if the economy is doing well, and that means they're not going to raise interest rates too early, that's actually a positive. That means people are out there working. That means consumers are spending. That means people are enjoying themselves. That means things are going along. And if that means a short-term hiccup in the stock market for the benefit of kind of everybody out there, it's probably a good thing, because if they had already cut, one and planning on 2 or 3 more times or 4 times, that means they see something coming down the line that isn't very good, which means some sort of recessionary triggers are going off, which we haven't seen yet. Not that we won't, but we haven't seen them yet. So I think it is a positive that, I have to be glass half
Yeah.
full, Tony. So I think
Yeah.
it is a positive that they haven't done it as far as for the economy. Would have liked to see that number come in a little tighter. Obviously we want interest rate cuts for the reasons I stated earlier. And for the market, once you start cutting, companies are like people. They want lower rates to borrow funds, to grow their businesses, to hire employees, to expand, and they're waiting too. They're kind of in the same holding pattern that you are, with your house currently.
Yeah. Yeah.
You know,
Well, I think you make some good points, and I think the key here is work with a financial professional like yourself. And now is not the time to be a DIY, do-it-yourself type person
Mm.
when it comes to your portfolios and your investments. And I know you have your clients in actively managed accounts by professionals, and you're keeping an eye on it so they don't have to worry. They don't
Right.
wake up this morning and see, oh, the Dow dropped and the numbers aren't great. They don't have to panic.
And they
Oh
shouldn't be
man,
doing that.
I'm not going to be able to retire. I'm going to panic.
Right.
They don't have to, because they have a plan in place. Their money is being smartly managed,
Mm.
actively managed
Right.
by reputable and people with a good track record too. So
Right.
I think that's huge. So our listeners, the way to combat inflation and the stock market is to have a solid investment plan in place and retirement income plan if you're nearing retirement.
Right. You're 100% correct. Have a plan in place. our clients shouldn't be looking at the market and going, "Oh my gosh, what am I going to do?" They shouldn't. If we're doing our job, they shouldn't be doing that.
Right.
When we're meeting with them, 2, 3, 4 times a year, depending on the individual, we're reviewing this stuff. We're going through it. And we've went through lots of this over the years. There's always something. We went through, several different cycles, and at the end of the day, it's the market is going to do what it does, and it still goes up and to the right. And as long as you're patient and you don't panic, I think that's the recipe for success. Even dealing with these high numbers, and just be hopeful that they start going in the right direction. Maybe the next print that comes out.
Yeah. Very good.
All
Well,
right.
we talked about the inflation nation that we're in.
Inflation nation. That's where we are right now, Tony.
That's where we're at.
Inflation nation, like
That's
it or
where
not.
that's where we live.
Yeah.
All right, Rob. So before we go, let our listeners know how they can get a hold of you.
You can go straight to our website, go to apadvisorsgroup.com. All the information's there. If you want to sit down with us, you're able to do that right there. And we have lots of great videos on there and things that you can learn from. So take advantage of that. Go on there, just peruse your way around. And, if you want to sit down with us, you fill it out or give us a call.
All right. Well, great show today, listeners. That does it for today's episode of Ready, Aim, Retire with our host, Rob Kirvan.